Alright guys, welcome to another video today. Um, Today I would like to share about why you should learn short-term trading before starting on long-term investing. Right. So this is my view and my ask. Be open to what I'm going to share. I feel strongly about it, but this is still my view. May or may not benefit you. You may or may not agree with it, but that's what makes us diverse. Nevertheless, I guess the bottom line is so long you're making money, realize profits, that is, you feel free to differ. Okay? Firstly, I'd like you to look at these two charts over here, right? And tell me if you can tell which time frames are of each. They are both SPY charts. And if you could tell, I mean, generally both are in a bullish trend, especially over here. So what time frames are these? All right. So actually one is the weekly and the other is the 15-minute chart, right? So what I want to say here is that you can see both looks highly similar but actually different time. Proves that price is fractal. The price that it appears on the higher time frame, like weekly, monthly, yearly, could be the same as what appears on a lower time frame, like 5 minute, 15 minute, 1 hour, right? So when you're long-term trading, you are minimally looking at the daily chart, and at a lower time frame, it can also resemble a daily chart, which is what I mentioned. Hence, when you trade short-term, my point is you can replicate that on long-term investing because of the nature that price is fractal. Okay. The first problem I would like to highlight of long-term investing is probably the first time that you are exposed to for any beginner out there, budding investors, because social media gets to you first, and the algorithm, the ads get to you. Then you be filled with messages from gurus and professionals asking you to invest to beat inflation, right? But why do most investors lose money? Because you're painted a picture of making easy money, like, oh, 4% is very easy. But you become the easy money instead, ironically. So on one side of the coin is if you realize that could they be encouraging your participation in the market, okay? And if they are after your money, they earn your assets under management, the management fee, 1% of your management fee, yeah, or even for the game meme stocks, yeah, they are garnering your participation, but then they left you hanging, right? So in a more not so risky investment, you would do some homework, right? And you find that yeah, it's true that markets are predisposed to go up in the long term, and you decide to invest. And because of that, you started to buy some stocks and made some a little bit of money, whether it's realized or unrealized. I would like to guess that it's unrealized, and you start to become overconfident and put in more. All right, then the price starts to come down because you are only knowing how to buy. You don't know how to sell yet, and you don't know that this little correction could be a while or could be a very long. And you choose to double down again because hey, buy the dip, right? Buy the dip and double down, and then your losses are amplified. Is that a familiar feeling? Right? And another saying also is that the media says, actually this quote from Warren Buffett, that diversifications for idiots. This is how actually he got rich because he was concentrating his money on, if I remember correctly, it's 3 stocks, and that's how he started off. Right? So the media paints you a picture that you need to gain experience and decipher what is real. Right? The next slide I talk about is risk, and it's an understatement, right? Few know what risk is until they lost their monies, right? everyone keeps covering their assets, saying not financial advice. Always consult a financial professional advisor. Did you? Yeah. They ask you to, but do you? And they will say, put up what you're willing to lose. But then, how true is it? This is just a generic statement. So let's say you put 100,000 in, and you incur a unrealized loss of 10%. It's $10,000 paper loss. But does it hurt you? What if it drops further? What's your tolerance limit? Okay, what's that figure that you have in your mind? Okay, are you really willing to lose all this 100k when it goes to 80k, 70k? Can you weather that amount of risk? So you must be aware of what is that figure in your mind. Okay, the first principles of investing is always protect your capital. No money makes no money. Okay, if you don't have any money, you don't think about making money, right? And the next thing is when they don't or rarely talk about risk. And I wanna say that they don't even ask you to put a stop loss. Alright? I don't ever really see that people talking about placing stop loss because we are all long-term investors, right? We buy and hold for 20 years. But in reality, it's in the professional realm that people cut losses because they are accountable for the funds under them, right? They need to reduce the loss because they're responsible for the gains and the money under them. So why would you not do the same, right? So the third thing about long-term investing is reproducibility, right? You always go and find the next 10x stock, but I mean, really, how many times can you really replicate and reproduce that, right? What's the chance of finding one 10x stock in amidst so many stocks that are available in the world, right? You spend tons of effort, mind a typo over here on the fundamental analysis, and then suddenly one black swan news or some insider news disrupted the stock, and you lost a lot of money. I'm mentioning liquidated here as an exaggeration, but yeah. So some even go to extremes of fundamental analysis that they go to the work site and they count the actual number of employees working at the company to see really how is the employee and the culture, is it a company that's worth investing? And all this is really very subjective. And I mean, if company is earning money, consistently having a free cash flow over the next 5 years, we could say that yes, it's definitely a company that is stable and all, you could invest in it. But I think the human greed factor is that we always want more. We want to find the next 10x stock, right? So what I mean is that when we do this type of fundamental analysis and the effort that you put inside, right? How much of it really turns out in your favor, and you could even realize it. You actually have a profit target in mind that you will sell your stock and get the money back in your hands, or you're just holding and you have no idea in mind when you are going to sell. So in all these efforts being used for long-term investing, I don't know, is it a reproducible result, or does it sound more like a gamble? You're just trying to find this stock. I feel that it can go 10x because of these factors. But yeah, but just hear me out, alright? So for short-term trading, conversely, what you can do here is you learn how to measure the risk, right? Before you enter, you set aside, this is the amount I should lose, $100, and that's it, right? And then you enter at specific patterns. I'm talking about technical analysis here. You plan your exits, right? Should I hold for longer? Should I just pay myself earlier? All right. It's all about greed and how you manage yourself and managing your position during a trade. Is talking about trade management, right? If your trade goes sour, what do you do? How do you cut your losses? How do you preserve the capital? That's the core requirement for you to make money, right? So if you could apply all this, you could actually reproduce the results over statistics of over 100, 500 trades if you could follow the same method consistently, right? And that's the key, because people are not consistent because they often sabotage themselves with too much risk, losing trades and then doubling down on their losses, and being too greedy and not paying themselves while when they have reached a specific profit target. Yeah, these are some just pitfalls. So what I described about long-term investing just was also could happen in short-term trading. In fact, you at even accelerated rate, because right, the candles paint faster and you react to them live. They induce you to buy and sell and exit to enter and all that. And all that you experience at long-term investing, you could also do this in a short term, right? Conversely, what you could become is a disciplined trader, just like the professionals. You become an excellent risk manager and executor. You follow your system, your method. If it does not offer you your setup, you do not enter, right? And you show and prove yourself that you are up to the task. You can manage funds, large funds, right? But it takes a lot of work and effort because you are solely accountable for yourself. You don't have a boss to coach you for your wrong decisions. You don't have a person to encourage you. You only have yourself. All right, so that's the greatest thing. Could be a pro or a cons. Okay, if you develop and believe in yourself so much, you are able to, propel yourself and develop further. But if you are unable to, encourage yourself and pick yourself up from setbacks, then you'll take a longer time or eventually choose to give up. But should you continue to persist, your reward is very great, because it's not just what results that you could achieve, but the character you develop as a disciplined person. It spills into other aspects of your life. Right, in summary, there are benefits to short-term trading, like I mentioned, that can be applied to long-term investing due to the nature of price being fractal, right? So when you learn how to enter and exit and manage your mindset, not to be too greedy, you know, don't don't need to follow others. They may not be posting their losses, all right? They're only posting their gains, and that's not a full picture, right? And I hope all these that that are shared, provide some logic and make sense and value. Most importantly, in educating you more about financial market. And that's all. I'll see you next time.